Hello financial fans, welcome back to another stock analysis. Today we'll be covering Texas Roadhouse, stock ticker TXRH. Texas Roadhouse is a casual dining restaurant chain that specializes in steaks and other American cuisine, such as ribs, chicken, and seafood. They are known for their legendary hand-cut steaks made from scratch sides and fresh baked bread. The restaurant also features a lively atmosphere with a Western theme, and many locations offer live music and line dancing. They operate in locations across the United States and in some international locations, and also have a small chain of restaurants under the name of Bubba's 33 that serves pizzas, burgers, and beer. They also have a catering service to provide meals for any occasion. Their market cap is currently sitting at $6.75 billion, and in 2021 they generated a revenue of $3.46 billion. Their dividend yield is currently sitting at 1.82%. In our final valuation, we'll be using a margin of safety. This will be based on financial ratios, financial health, and the growth of the company. And the standard margin of safety that we'll be using is 25%, which can either increase or decrease based on the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT is barely visible on this chart, sadly, but it has grown from around $117 million to $298 million in 2021. The average growth in EBIT during this period was 14.9%, meaning a 5% deduction from a margin of safety. The margin, however, has gone from 9.26% to 8.6%, so it has decreased during this period, with an average margin decrease of 0.51%, meaning no change in our margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have steadily gone up and have only taken a hit in 2022 when we had the lockdowns. But it has gone from 48 cents a share annually to $1.60 a share annually. The average growth in dividends during this period was 19%, meaning a 10% deduction from a margin of safety. The payout ratio is sitting at a very solid 55.9% payout ratio, which means no change in the margin of safety. The final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the companies to pay off all of their debts, which for Texas Roadhouse is just under 1 year, meaning a 96% debt to EBITDA ratio, which is a 5% decrease from a margin of safety. The return on invested capital for Texas Roadhouse is 12.2%, meaning another 5% deduction from the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Texas Roadhouse. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in cash flow during this period was 36.13%. But since we're calculating the lifetime expected growth in cash flows for the company, I've gone with a very conservative 20% of this average growth, which is still 7.23%. Using this percentage, we can determine the future free cash flow of Texas Roadhouse going to 2030 and then determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. The sum of free cash flow then is a valuation just over $6.5 billion. To get our equity value, we have to add the cash and equivalents and subtract the debt. The equity value here is just under $6.2 billion. And the last thing we need to do to get our discounted cash flow price per share is divide it by the shares outstanding, which for Texas Roadhouse is 66.91 million shares. The discounted cash flow price per share here is $92.09. And with the current price of $100.97, the downside here is $8.88, which is a 8.8% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payments going from 4 years ago to the current year. The average growth in dividends here was 77.36%. This is mostly because it was skewed by the lockdown year, since it went down a lot that year and it went back up to the old standards. But since we're once again calculating a lifetime expected growth in dividends, I've gone here with 6.5%, which seems much more reasonable. We'll also be using a discount rate of 8.5% here again. And out of this model, then we get a price per share of $97.98. And with the current price of $100.97, the downside here is almost $3, which is just under 3% downside. The last model that we'll be using is the multiple valuation. By looking at companies that do similar business to Texas Roadhouse, looking at their stock price and their earnings per share, we can determine an average PE multiple in the industry, which in this case is 21.16. The thing that's left to do to get our fair value is multiply it by the earnings per share that Texas Roadhouse is generating, which is $3.84 a share. Out of this, we get a fair value of $81.27. With the current price of $100.97, we here get a downside of $19.70, which is a 19.5% downside. Let's go look at the final overview of our valuation model next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, and the multiple valuation price per share. Out of this, we get an average of $90.45. Our margin of safety has been determined earlier by using a standard margin of safety of 25%, deducting 5% for the debt to EBITDA, deducting 5% for the EBIT growth, deducting 5% for return on invested capital, and deducting another 10% for the dividend growth. This leaves us with a margin of safety of 0%, so no margin of safety at all. The fair value then is still $90.45, and with the current price of $100.97, the downside is 10.42%. If there's any other companies that you would like to see on this channel, please let me know in the comments, and thanks for watching.